Welcome to the Real Estate Asset Management Podcast, brought to you by Break of Day Capital. The show focuses on educating syndicators and apartment owners on how to build systems and manage their properties more efficiently to become a best-in-class operator. 100% straight talk. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Asset Management Podcast. I'm your host, Garylipsky with Break of Day Capital. Be sure to join our Facebook group, Asset Management Mastery, where we have a great community of like-minded individuals sharing resources and best practices.
Choosing the right insurance coverage for multifamily properties isn't that complicated if you know who to talk to. At the Garzella Group, we're uniquely qualified to help you navigate the range of policy choices you have, and we're committed to saving you 30% in the process. We do intensive market research and have nationwide relationships, so we can find coverage other insurance brokers simply can't. We should talk. Go to quotenow.biz and we'll start the conversation.
Today on the podcast, we have Andrew Rybczynski returning. Andrew was a guest on episode 73 about 6 months ago, where he spoke about multifamily investing outlook, and he's back to do the same. A little bit about Andrew. He's a managing consultant at CoStar Advisory Services, where he makes recommendations on investment, commercial real estate, and writes on the multifamily property type, and has been published in the Journal of Portfolio Management. His work is often referenced in national media outlets such as WMRE, the Washington Post, and the New York Times. Welcome, Andrew. Can you start by telling the listeners a little bit more about yourself and what you do?
Sure. I've been with CoStar for 9 years now. The job that I do, the group that I'm with, mostly focuses on advising institutional investors. I myself tend to focus on multifamily, and we do a lot of data crunching. CoStar, of course, is the largest owner of commercial real estate data, certainly in the U.S., most likely the world, and we have full access to that data, and we're able to gain a lot of insight by doing some number crunching on the back end there. And to that end, some of this information that will be discussed today may be by its nature be my personal or subjective opinion and not necessarily reflect the views of CoStar Group. Any forward-looking statements are believed to be based on reasonable assumptions, but are subject to change and not necessarily comprehensive given the format. Most importantly, nothing said during the podcast should be construed as investment, tax, accounting, or legal advice, or as a promotion of the advisability of any particular investment.
Well, I'm excited to have you on. Obviously, we've used CoStar many times for data, and we love data. So it really lets us make much better decisions. So let's jump in. So I know you've got the Q1 data is out. Obviously, things have changed quite a bit since the last quarter. Any surprises in the report?
Nothing surprising if you were paying attention. I think a lot of your listeners were paying attention. But we had that huge demand year in 2021 that just blew everything out of the water percentage wise, raw demand wise, and of course Q1 this year is coming back to normal and actually a little bit below normal. So it was. Yeah. If we look back historically, it was actually a pretty weak quarter. I do think that a lot of demand got moved forward during 2021 because of things like stimulus spending, because of kind of a little bit of a freeze up in the housing market, and not least of all because evictions got paused. Most places, most of the year, and continue to be paused in some places. So all of that kind of helped boost demand. Of course, brought us down to record low vacancies and gave us that incredible rent growth last year. But going forward, we should expect a little bit more normal demand and even a little bit below normal, just because, again, we drag some of that forward and the demographics are weakening a little bit.
Yeah, I remember, waiting for NHMC to happen, and brokers were bringing out all these deals, and that never happened. There was talk of it, and we've been very active as an organization, but there just hasn't been the amount of inventory out there that we were expecting. So that was surprising for me.
When you say inventory, you mean available for sale? Or?
Yeah.
Okay. Yeah, it doesn't surprise, the transaction market, I think, is still moving pretty well on a volume basis. But perhaps in number of sales, you're seeing a little bit of a dip. Of course, the volume is a little bit counterintuitive, perhaps, because cap rates have dipped so low, of course, that less units moving can mean a lot higher volume. And we've seen cap rates dip quite low in some of the growth markets that used to be associated with higher cap rates, to the point now where we're measuring several core markets above the transactional cap rate average for 2021. So the secret's out about those growth markets, and folks have really folks have moved in there, and they are now paying for growth in a way that they didn't necessarily have to 4 or 5 years ago.
Yeah. So we've been active in Phoenix and Tucson, and Phoenix, it's just astounding, the competitiveness for deals, and the broker will come in with a whisper, and the whisper gets just blown out of the water when everything is said and done. So it'll be interesting to see how that plays out. But yeah, they're counting on this tremendous rent growth still happening, and who knows what it will look like in 6 months, 12 months.
Yeah, I mean, we are starting to see rent growth weakening a little bit. It depends on where you look exactly, certainly market by market, and then within markets. So suburban rent growth is actually, it's pretty much on track with where it was last year at this time, whereas prime urban rent growth has started weakening a little bit. And there's a few reasons why we would have expected that. Certainly, I've been saying suburban for several years now, but a key one is just demographics. As I say, the demographic story for pure renters is weakening a little bit. But as they get older, we do think that they're going to tend to move to the suburbs a little bit more, chasing, frankly, schools. So that demographic tailwind is in effect. The idea of a commuter being willing to commute longer, less often, I think is going to be in effect as remote working does become more normal. Not necessarily the norm, but more prevalent, certainly. And then there's also the supply story. Supply has been coming in heavy in prime urban areas for a decade and a half now, where it's been pretty weak in the suburban areas, and the fundamentals are just better out there. So that, of course, helps drive that rent growth.
So, obviously, you just talked about the move to suburban. What are there other concerns that you have for multifamily investing as a whole, short or long term, or more of location wise?
Yeah. So I do want to circle back to cap rates because you sort of talked about that, but looking at the demographic picture, as I say, your traditional main cohort of 20 to 34-year-olds is projected to start actually shrinking in 2023 or mid 2024, perhaps, shortly anyway. The kind of not so secret though is that over the past 10, 15 years, a lot of the renter growth has actually been driven by much older cohorts, say 55 or even 65 plus. And that was just a population story. It's not to say that they were more likely to rent, but there were just a lot more of them. And that growth is starting to peter out as well. So there's still strong growth in the 85 plus segment, but that's more a healthcare story than it is a multifamily story. So that pit, the boomers are sometimes referred to as the pig in the python. That pig in the python is it's kind of done at this point. And so as I say, the demographic story weakens a little bit. Now there are counter stories to that. For instance, basically later later markers of adulthood for young people. We know that the age at first marriage and the age at first birth and the number of births are all pointing towards longer renting. 20 years down the line, that could come back to bite us, but for the time being, it's a bit of a positive. But that raw demographic number is no longer quite the growth story that it used to be. Now that's now you mentioned location as well, though. There are big differences locationally, of course. The sunbelt and the South, we expect to continue to grow pretty well. Not as fast as they used to, or not as fast as they were, but still better on a relative basis. And that's that again comes back to that cap rate differential that I mentioned.
Yeah, it's when you're investing in sunbelt states, it's just you're just riding a wave of of population growth, and there's when we walk comps, and there's just no vacancy anywhere. There's such a demand. It makes us look really smart as operators. We could take a punch, and it makes our lives easier. But there's opportunity everywhere, depending upon how you buy and whatnot. But
sure,
our investment philosophy is usually in the Sunbelt states and riding that wave. We'll pay a premium to be there, but we'll also extract a premium when we sell.
Yeah. So like you said, it makes you look smart. Well, I would argue if you were buying in the Sun Belt in 2012, you probably are pretty smart. The relative return versus risk in Sun Belt markets now looks pretty obvious, but at the time there were still questions, and I'm going back to 2012. There were still questions about how is Phoenix going to recover from this massive housing bust that was just a few years ago. But as we know, the bet worked out. But today, though, again, we do think that there's been a bit of a rationalization in the market, and so you've got very low cap rates in Austin and Charlotte and Raleigh and Phoenix, and of course, if you were to assume that you can maintain perfect occupancy, they look very attractive in the Midwest. And that's that is something to balance. It's as I say, the market, it's not perfect, right? But it should rationalize eventually, and to that extent, there may be opportunity in the Midwest on a deal by deal basis, of course. But I did, as I mentioned, I kind of wanted to circle back around the cap rates and where they stand versus the 10-year, and triple Bs, because we've had an enormous run up in interest rates over the past 3 months or so, and it's made things a little bit touch and go. One interesting stat that I think is worth quoting is that for the past 2 years or so, virtually nothing in terms of cap rates traded below triple Bs. But last quarter in multifamily, about 15% of deals were below triple Bs. So that's a meaningful number. That's not at all the highest number that's ever been, but it does tell us that spread is starting to tighten.
And I'll cut you off real quick. Can you explain to the listeners, for those that don't understand, what triple Bs is?
Sorry, yeah, it's just corporate bonds. So corporate bonds, of course, have different gradings. AAA being the most sought out, or the least risky. Not necessarily most sought after, because they tend to have the lowest returns. But triple Bs are often considered a decent allegory for commercial real estate. It's mostly in terms of office, in that your average tenancy credit for an office building might be triple B. Hopefully you have AA and AAAs in there, but you've probably got even some ungraded tenants in there. And so the triple B was kind of typically used as this, as I say, allegory for what's going on in multifamily, in commercial real estate. And we still use it for multifamily just because it's kind of been adopted as a, not quite industry standard, but it is widely used. Anyway, so as the triple B rises along with all interest rates, Real estate is generally considered riskier than triple Bs and certainly than the 10-year. And so as those go up, historically, you would expect cap rates to rise as well, because if it's a riskier asset, then you should have to pay less for it. But there is an argument to be made against that right now. Basically, that cap rates can invert against certainly the triple B and even the 10-year. And we based.
So obviously you have no crystal ball, Andrew, and I'm kind of putting you on the spot here. It's the $1 million question. Like, where do you think cap rates are headed? If you were to take a guess.
So at a minimum, I can say that the spread between cap rates and the 10-year, let's use that as our benchmark, is going to compress. Now there is a case where we actually see that compression go negative, in a cap rate inversion. So we know that this happened back in the 70s, early 80s, when inflation was running rampant, and really the market didn't believe that the Fed could control inflation. That's essentially what would have to happen again, is that not only would we have to have inflation, but the market would have to believe that the Fed can't control inflation. Which would cause the 10-year to spike up quite a lot, as people would no longer be willing to buy at 2.5% with the belief that was going to be a massive negative real return. And of course, we saw the 10-year spike up to close to 14% in the early 80s. Unimaginable right now, still, but it did happen. Now, the thing about real estate is that as much as we compare cap rates to bond rates, it's not a bond. In that a bond, of course, returns a reliable and consistent annuity, and real estate has upside. And of course, that upside is rent growth. So in a situation where you see high inflation, you would expect reasonably high rent growth as well. And of course, we know that that's part of what drives inflation is rent growth, and we've had enormous rent growth over the past year. So that does make a case for an inversion, where yes, your going in cap rate might indicate a negative real return compared to your inflation expectations, but your expectation of NOI growth outpaces that real loss, and it really complicates underwriting, of course. But it certainly, it's not only theoretically possible, but as I say, we do have evidence that it happened.
So when someone is underwriting, where do you think that they're underwriting to a version of, let's say in Texas, a 5% reversion cap, they're buying it at, let's say, a 4.
Mm-hmm.
Predict in the next, and what I'm reading is that it might go up a little bit, then it's kind of going to come down. So it's like the short-term blip, but I'm not an expert. You know a lot more about this than I do.
Yeah. So of course, the Fed's term has been much maligned. Transitory, yes. Transitory inflation has been much maligned. To some degree, it's about what you consider transitory. Our view is still that supply chains will become unsnarled, and as the Fed has telegraphed raising rates, demand that's going to create a demand cut, and so both of those have a downward impact on inflation. And so we don't really anticipate a prolonged period of inflation. At least I will shout out the folks who don't necessarily follow the traditional measures. We don't anticipate CPI having a prolonged period of high inflation, and so that would lower rates back down. So in terms of what that means for cap rates, yeah, we would anticipate a little bit of upward pressure, but again, just because of the rent growth, the equity portion of what real estate is, we would anticipate that it's at a minimum, as I say, those cap rates are going to tighten and become pretty close, and we would anticipate that happening really more than any sharp upward tick in cap rates.
And for sponsors out there, investors, do you see a better opportunity? And this is a very general question, but a better opportunity in Class A, B, or C right now?
Yeah, it really depends on what you're looking for. B and C have traditionally had better rent growth. So if you're looking to go in and maybe make a few improvements, but really just looking for kind of a cash machine, such as it is, it's a pretty good bet. And like I said, the returns do actually tend to outperform. And I'll speak to Garden as well. So I'm not sure if you're familiar with NCREIF, National Council of Real Estate. It doesn't matter. NCREIF. They have a very good return series that goes back a long ways, and it does show that Garden has outperformed for a long time. And to some degree, I think that's because it's not cool. It tends to be out in the suburbs, tends to be older, tends to be low slung. It's not a pretty investment. And so I do think that there's
Well, Andrew, thank you so much for coming on the podcast and providing a ton of detail on Q1 data and where the market is headed. It's so valuable for operators and investors. Can you tell the listeners a little bit more about where they could find out more about you or CoStar?
Sure, of course. CoStar.com, COSTAR. As I say, one of the largest providers of commercial real estate data in the world, and a lot of my content does get pushed to our news feed. So there's a lot of good stuff on the front page, and of course that data is all in there.
Awesome. Well, thanks again. I'll be back next week with another episode on the Real Estate Asset Management Podcast. Thank you so much.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and review this podcast, as it will help us grow our audience and reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website, breakofdaycapital.com, and sign up for our newsletter and or fill out our investor application. We'll talk to you next week.